welcome to episode 24 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya.
And my name is Tamanna Surya.
And today we are thrilled to have Luis Sanchez as a third guest on this podcast.
Thank you guys so much for having me.
Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of this podcast for more detail.
Luis, thank you for taking the time to do this podcast with us. I have been following your work for years, and I've also appreciated our quarterly check-ins where we, get together and share some ideas. Luis, as an introduction, runs LVS Advisory, a financial advisory and investments firm. Luis, we would love to have you take a few moments to basically introduce yourself.
Absolutely. So I am the founder and managing partner of LVS Advisory, and we're structured as a registered investment advisory firm, formerly based in New York City, but I've relocated to Central Florida. And we advise all sorts of clients, high net worth individuals, as well as institutional investors. We have 2 discretionary investment strategies that we run, and we also do some financial planning and wealth management on the side. And that's an overview of what we do. And, as I'm sure we'll get into, we have 2 active investment strategies that I think are pretty unique, that is pretty much the bread and butter and heart and soul of our operation.
Right. So why don't we jump right into it? Luis, what made you want to start an investment fund? And as you said, I think the especially unique thing about LVS Advisory is this 2-pronged sort of approach with your merger arb or event-driven strategy and then your growth strategy. What led you to this sort of structure?
Sure. I'll back up a little bit. And prior to getting into investing, I worked in investment banking. I worked at a few different shops. And in the last job I had, I was on the hostile M&A and shareholder activist team at Credit Suisse, where we basically were dealing with like the hairiest mergers. We were a specialized group, and we were often on the other side of activist investors, so often on the same side as hostile M&A players. And it was a really interesting and great seat to learn a lot about how mergers work, but like how hairy mergers work. And that's, I guess, where my interest in event-driven started. And prior to that, I got interested in investing in college, and I was really just attracted to the intellectual rigor and in some ways gamification of how it all works. I've always been a huge game nerd and strategy game guy. And, that whole time when I was an investment banker, I was reading everything I could, reading all the books about investing, reading investor letters and Value Investors Club and you name it. And after leaving the sell side, I joined a startup hedge fund, and it was focused on quantitative investing. And that was also a really interesting experience because part of what my job was to come up with what would be interesting models, and which involved using all that literature and everything I knew about what made a good stock pitch and trying to translate that into like a quantitative rule set, and then running a number of back tests and testing the back tests and, looking at out of sample and versus in sample data. And then we actually launched. I joined pre-launch, and then we launched the fund, and I was there for a few years, and it was a really great experience because I was at a startup fund. I got a lot of operations experience as well, and I got a lot of exposure to what investors were looking for, which was helpful. And effectively, like a couple of things I realized was that as far as, to be an active manager, you really have to be doing something differentiated, either in terms of generating really amazing performance or doing something that's very uncorrelated and very niche. And, really ever since I left the sell side and I had that job where I was exposed to hairy mergers, I was doing a little bit of merger arb investing in my PA. And I was just, honestly, it was a way for me to keep, I thought it was interesting. It was a way for me to follow deals, which I was always interested in after working on the sell side for 5 years. And one of the things I realized after a few years of doing it was that a lot of event-driven situations not only could generate very attractive returns, but completely uncorrelated returns. And really the light bulb went off for me in 2018 because I think that year, in the beginning of the year, there was the volatility products blew up and there was like this crash sell off. And then at the end of the year, when we were getting interest rate hikes, the market sold off 20%. And I had this little like merger arb play portfolio that was basically just a very steady line every month, was up and to the right, and it ended up crushing the S&P, but it did so with basically zero volatility. And putting everything together, I was just like, okay, this is a really interesting product because it wasn't something that was easy to access as an investor. And so, long story short, at the beginning of 2019, I started LVS Advisory, where the core idea was I set up an event-driven strategy, and the aim of the strategy was actually to just have, like, basically not go for the hairiest deals, like the type of deals that I was advising on, but to go for more of like the singles and doubles and try to deliver a product that could give bond-like exposure, but offer something that was uncorrelated both to bonds and stocks. And that's how I went about it, with the idea of like, if we can deliver high single-digit, low double-digit returns, but give folks something that's just totally uncorrelated and has relatively good downside protection, I knew that would be valuable to me. And, based on what I knew about investor psychology, it seemed to resonate with a lot of investors too. And that's how I got started. From there, I've developed the firm in different ways, which I can get into.
Sure. And that resonates so much with me, Luis, because for the better part of 10 years, at least on the personal side, I've been thinking about, the 60-40 portfolio, where most financial advisors will put you in 60% stocks, 40% bonds. And instead of that 40% bonds, I used to use merger arbitrage in my personal portfolio for the exact same reasons you mentioned. Right. And I mentioned that in my book as well. I did have one person who reviewed the book before it was published who didn't quite agree with it. And he used to run a $4 billion event-driven fund and is a legend in the industry. So I need to revisit why he felt like, they aren't exactly a good replacement for bonds. I would love to hear your thoughts if you have any on that front.
Well, absolutely. And first, I actually should give two shout outs as to inspirations for starting the fund. One was, I think around the same time, Mario Gabelli wrote his book, Merger Masters, which I read and got a signed copy from him when he gave a talk at Columbia. And, I had an opportunity to ask him some questions in 2018 about he's been practicing merger arbitrage for a long time. And I asked him, like, why bother with merger arb when, just buying the S&P will significantly outperform? And he put it in a very straightforward way. And he said, well, this is about the magic of compounding, because you could look and see that as long as you can keep compounding and don't take any big losses, you're going to do quite well. And most people don't hold through the volatility of the S&P. So for some people, who have lower risk tolerance or lower risk appetite, this is even better than the S&P because of, the tendencies of some investors to buy high and sell low. And then honestly, the second shout out is you, Asif, because I was reading your work when you were publishing. You used to publish, you had some articles that you put up. I know for sure on Seeking Alpha and probably on your own website as well, where you talked about, the success rates of merger arb and like the base rates. And, you could apply this really quantitative analysis where you look at the deciles of returns and the success and the probability rates of deals getting completed. And I know you and I have had a lot of discussion about some of those stats over the years as well. Once I got, I knew intuitively just through my experience, my personal investing experience, but also my professional experience of working on deals, of how these deals work, and they could be good investments. But then seeing the data that you laid out and, learning more from like a master like Mario Gabelli really helped me to internalize like, oh, actually there's probably something here, that this is actually something that could be turned into a real investment strategy. Now, onto your point about, is merger arb, a good proxy for like a fixed income portfolio? I resoundingly think yes, it is. And there's a lot of academic data, a lot of academic research that supports this, right? Because you could look at, there's academic papers that go back 50 plus years that look at what is basically the merger arb spread. And the merger arb spread, if you map it out as a spread against above like the 10-year, is really, really similar to the high yield bond spread, actually. It's within, there's some cyclicality over time where sometimes high yield bonds have a bigger spread, sometimes merger arb has a bigger spread. But as an asset class, it's really consistently priced similarly as a high yield bond asset class. The differences, and why I think merger arb is actually a superior asset class to high yield bonds, is high yield bonds have that correlation to equities. Whenever there's a business cycle and equities sell off, high yield bonds have that high correlation, whereas merger arb is different. Like certainly some deals blow up, but actually something that I realized later on after doing more work and like researching the asset class more, is that there's been a lot of innovation in legal contracts in merger arb. And I think, merger arb has a really bad reputation where people assume that it's picking up pennies in front of the steamroller, right? Where whenever you get like a big financial crisis, you're just going to see like half the deals blow up because people can just walk from deals. But if you actually look at, so that may have been true 20 years ago. In fact, I think it was true. But there's basically all these things that have been put into contracts by smart lawyers that have made it exceedingly difficult to walk away from deals.
Oh, you're so right.
And I actually think that's an inefficiency. And maybe I shouldn't be revealing all my secrets here. But when I look at a merger arb deal, the strength of any, I have I think maybe before I get into that process, like the way that I think about like risk management and like quote unquote stock picking in merger arb is very similar to how like a bond manager picks, which is like you want to find something that has a good yield because for the most part your return is generally fixed, right? And that's not entirely true because there is a little bit of, you get a free call option with every merger that somebody might come along and try to pay more. Which I also think is an inefficiency, which you don't really have that in high yield bonds. And if I looked at like my return distribution, there's been usually about once a quarter, definitely a couple times a year, I'll have a situation where I make a lot of excess return because one of my deals went off to a higher bidder unexpectedly. In fact, it happened very recently with the deal that TransDigm agreed to pay a significant premium over another, actually their own offer, but it became a competitive process. But the point is, what bond managers are looking for, as Howard Marks puts it, it's a negative art. You're really trying to find deals that have good yield, and you're trying to avoid the losers. And I think of merger arb as really similar. You're trying to find things that have good yield, and you're trying to avoid the losers. And this is where I felt like my skill set as somebody who's worked in like the hairiest deals really comes to play, because when you're working with really hairy deals, you look at like three things, and these are like the three things that I specialize in when I look at any deal. The first is you look at the contract strength, right? You read the terms of the deal. What are the like? Is it a strong contract? Can the buyer walk away from the contract? What are the outs? Some contracts have outs, and you have to look out for them. The second is, will the shareholders approve a deal, right? And you have to be able to read a shareholder base, look at the board, understand the dynamics. And, that's definitely something that is a bit of a skill and something that you have to learn over time. And then the final thing is you have to look at the regulatory risk, because that's the third way that deals die. And you have to just kind of know, okay, is this an industry that's going to have a lot of regulatory scrutiny? And a lot of that to me comes down to just historical case studies and having the data. And that's, frankly, also a SIF where your service inside arbitrage is very helpful, because I can go and search through your website, and I'm a subscriber, and I search through your website, and I could look at a bunch of case studies, and I could also use your website to see where deals are priced.
Speaking of case studies, I think the LVMH trying to step away from Tiffany is a really good example of what you were talking about, of how maybe 20 years ago when there was a financial crisis, you could see these target companies and the acquirers step away and claim the financial crisis. But in 2020, yes, LVMH, I think, negotiated a lower price by the end of it, but they were still forced to acquire Tiffany at the end of the day, right?
Yeah, and then looking at the data for 2020, I think even though deals failed, it's still about 89 to 90% of all deals actually went through. So that stat was fascinating to me, that during a pandemic, during everything shutting down, deals were still going through. There was also that situation with Elon Musk and Twitter. And people who were not familiar with merger arb would often come up to me and say, but you know what, he can pay $1 billion and walk away from the deal. And I was like, that's not how definitive merger agreements work. That's the termination fee. He can't just walk away from it. They'll sue him to perform. And that's exactly what happened. But, Luis, if you haven't been doing this long enough, that's usually the general perception. And I think that creates opportunities for people.
Yeah. And don't get me wrong. There's deals that come out even today that have bad contracts, that have bad shareholder dynamics, where there's clear risk. And, of all the deals that are announced, I invest in a minority of them, because I'm trying to find the deals that have that good yield. And so usually that's the first filter. And then amongst the deals that have acceptable yield, not all of them are investable, right? So you still have to be discerning. You still have to be discerning.
Absolutely. Among the 80 to 90 active deals that we track at any given point in time, I might invest in 3 or 4 of them. So I'm very selective on that front. I've had people reach out to me who are very attracted by large spreads on very tiny deals, the 30, 40, $50 million deals that are close to penny stock territory. And what I tell them is the shareholder base for those deals, they've pretty much given up on that stock, right? And the stock is down 99%. They can't be bothered to vote for that deal. And so every once in a while, what happens is you're wondering why the shareholders are not voting for it. Because if this deal doesn't go through, the company will go bankrupt. But really, at the end of the day, it is that they completely forgotten about this, couldn't care enough to vote.
Yeah, exactly. It's actually interesting that every now and then a deal doesn't close, not because it's a bad deal, but just because they couldn't find the shareholders.
Yes.
But, there's also, if you looked at the data, there definitely is like a size effect in merger arb, where because I think merger arb tends to be dominated by some larger hedge funds, to the point where there are some deals that are just too small for them to participate in. So a lot of times I do find some of the best deals in some of the smaller size companies. But, again, you have to be careful. You have to know the shareholder dynamics. And, there's certainly things that I look out for when I look at those smaller, more risky deals as well.
Yeah, every once in a while we will do a micro cap deal. I think both Tamanna and I were invested in the liquidation of First Financial Northwest. It took about 15, 16 months, a little bit longer than we thought it would. And it was a small deal. We did that. But when it comes below $50 million deals or a $1 or $2 deal, those ones, it's a hard pass for me at that point.
Absolutely. And I guess I'll add, that's kind of where I started with event driven. And then over time, you tend to figure things out, right? So then you tend, I think in 2019, towards the end of 2019, I started to figure out SPACs, and I was engaging in like more like SPAC arbitrage. And, I viewed it as really similar of like, okay, if you could buy basically a contract to receive NAV plus interest at below NAV plus interest, and you had a put option, that seemed like a no-brainer, at least if you could get a spread on that. And, there was a really nice opportunity to do SPAC arbitrage in 2020 when there was more sellers than buyers, I would say. And there was actually a period of time in 2020 where something like 70% of my portfolio was SPACs that we had actually bought.
Wow.
We actually had bought the SPACs below NAV. Well, it was a combination of two things, because one, nobody was announcing new deals in 2020, so there wasn't a lot of merger arbitrage for us to do. And then we figured out that we could buy these SPACs, and it felt at the time they were good as cash. And some of the details, some of that has been litigated, and some of the details of that have changed. And we don't own any SPACs today for various reasons, but it's an example of things that you could figure out. And that's why my strategy, I refer to as an event-driven strategy, because it's not just a merger arb strategy, right? I'd say merger arb is like about 75% of the portfolio today, but I'm always trying to find what's another kind of similar thing. And, where has that taken me? Sometimes it's taken me into, finding like preferred shares, or, looking at things that could be like, we've had situations where preferred is a good example, where we found a situation that was way over collateralized, where like the balance sheet of the common could have covered the prefs like 3 times over, but the pref was still trading at like a 40 or 50% discount and had a nice yield. And, occasionally you find things like that. Lately, a really interesting area for us has been looking at busted biotechs. That's another example. And it seems like every year we figure something out, and occasionally something that we had figured out is no longer an opportunity. So it kind of cycles in and out of favor with the way event-driven tends to work. But that's kind of how we think about it. The way we think about it is we're looking for a return profile, right? We're looking for a return profile that can give us a high single-digit, low double-digit net return with what I call as 95% confidence interval that we won't lose money.
Absolutely.
And so effectively, that's how I think about it. That's how I run the strategy. I incepted it with outside money in January of 2019, and we've executed. We haven't had a down year. We've compounded at over 8% net of fees, and I think our max drawdown is something like 5%, which happened during 2020. So, with those, and we've had zero correlation to any major asset class. So, and that really just shows like, okay, like event driven, it's not going to give you it could give you a 20% annualized if you want to lever it up and if you want to do hairy deals. We don't do that. We run completely unlevered. We don't really use any derivatives. And, we stick to things that I think are fairly safe, which is why we don't have a lot of volatility and we don't have big drawdowns. So yeah, it's an interesting niche.
Makes perfect sense. Event-driven is fascinating for so many reasons. But then again, you also have that growth portfolio. So I know you were talking about like volatility, high returns. Is that where you might see some of that? And what led you to the growth strategy as well?
Yeah, totally. So, it kind of goes hand in hand with event-driven, I figured out, because I launched my RIA in 2019 to only do event-driven. But I love investing. I've been interested in investing for many years, and prior to launching, I was looking at like all sorts of different types of stocks, value stocks, growth stocks, etc. And in my personal portfolio, outside of the event driven, I did have some exposure to growth stocks, or I call them growth stocks, but really growth is just to signify that like we're just looking for businesses that will grow our capital over time. And the other, the thing that I realized is that not only was growth not correlated to event driven, but it was actually anti-correlated, which is when my more growthier stocks were doing really well. It felt like my event driven was just kind of languishing. And when my growth stocks were getting killed, my event driven felt like it was amazing because it wasn't crashing. And I thought that was a really powerful concept. And with the acknowledgement of the way that I run event driven, I'm not going to have like 50% annualized returns. I'm probably limited to like, something in the neighborhood of like low double digit, unless I change the strategy. But, so what I thought was, okay, if I do a really good job protecting capital with event driven, there are opportunities occasionally where it does make sense to allocate to something higher beta, and that was the idea. And I actually got really lucky with the timing of this because I incepted my growth strategy in January of 2020.
Wonderful. What a time.
And 3 months into it, my event driven had like a pretty shallow drawdown, but I had this portfolio of really high quality businesses that I had actually been building that portfolio for a year prior to launch. So I was ready by the time it got to January. And, I called up all my clients when March came around and I said, yeah, like, look, your account is basically, where it was at the beginning of the year, but there's this huge dislocation in the market. And, I have a way for us to take advantage of that. And, for some people, they invested in me because they didn't want to take a lot of risk. But for others, they thought, what, Luis is right. Like, let's buy into this. And, we ended up having a really good year in growth that year. We my returns are public. We had like a 60+% year. But
Wow.
for the investors who bought in when growth was dislocated, we had some investors that first year of growth that had over a 100% return, net return.
That's phenomenal.
And that was my first year of growth.
Excellent timing there then.
And really what I'm looking for, and the way that I think about growth that maybe is also a little bit different from how other people think about it. First of all, I'm trying to create a portfolio that is optimized for returns and is not optimized for risk management. So, because if somebody calls me and says, "Hey, I want something that is low risk," well, I have a lower volatility portfolio I could give them. But, kind of also going back to that idea of if you want to be an active manager, you have to do something differentiated. My thought was, I want to, if I'm going to have it, there's so many growth managers or so many people who are doing value investing, who are aiming to be like S&P. And for me, it's like, I don't even want to refer heavily to any index. I just want to try to manufacture the best returns I can for the people who have that long time horizon and who aren't going to be sensitive to volatility. Because if I can ignore benchmarks and, kind of, it's basically growth is an unconstrained portfolio. We invest globally. We invest basically anything where I think we can drive outsized returns. So we have some micro caps, we have some large caps. We have some concentration. Our top 5 positions are more than half of the portfolio today. And, in over time that shifted a bit as well. And, that's the thinking. The thinking is I have these 2 strategies that are, they're not just active, but they're like defined by being active, right? Because an event-driven portfolio, there's a lot of turnover because deals come in and out. Mm-hmm. And in our growth portfolio, we're always looking for like the next big idea, right? And not to say we're not trading a lot, but we're turning over a lot of rocks. We make big positions. We try to get somewhat concentrated, and so that we can drive some outsized returns. And I feel really good about, we launched that in the beginning of 2020. So we're 5.5 years into that. And I think the results kind of speak for themselves.
Oh, that's wonderful, Louis. And you're so right about turning over so many rocks. I turned over a bunch of rocks just yesterday trying to find a single idea to write about for today. And it's just so hard to do that. You went to a little bit of what I wanted to discuss in terms of portfolio construction. So we talked about an event-driven strategy and growth strategy. And you alluded to a little bit of, having a concentrated portfolio, but diversifying a little bit over a period of time. So could you talk about that evolution? What made you go to a slightly more diversified portfolio than you used to have before?
Yeah, absolutely. So there's a long story here that I'll try to summarize, but the long story short is, in event driven, my portfolio construction is extremely rules based, and that's sort of made easy because there is a lot of natural turnover that happens in the portfolio. So it's more easy for me to have, like, when a new position comes in, say, okay, this can be a 4% position and I'm going to get the cash back in 6 months, right? Growth is a little bit different because cash doesn't necessarily come back. So, if you buy something really well and it goes up a couple 100%, you might be sitting on something that is an outsized percentage of your portfolio. And that's a good problem to have, but it creates a different problem. So, I went through this period where, after our first 18 months of growth, we actually had achieved a over 100% gain since inception. But what happened was our portfolio became really lopsided because, well, first of all, 2020, 2021 were like really weird years. So we had some positions that we had one position that was a 10 bagger in the first 18 months.
Wow.
And that's a lot of that was luck, obviously, right? And I think we had like 2 5-baggers, and we had like a couple of other things that were, that had done really well. And it left this really odd portfolio. And so I had this optimization problem where I was just trying to figure out, and the other problem that I had too was that the thing that was a 10 bagger ended up getting really expensive, right? And that happens too. And the things that went up a lot, some of that stuff we bought it really well in 2020, but then it became like a bubble stock in 2021 when the market went crazy. And I was having a lot of difficulty trying to figure out, okay, how do I land the plane here? Because I don't feel great about the valuations of some of these things. So I actually made a mistake, which was I over optimized the portfolio, because in my event driven portfolio, everything is mathematical. I can calculate the IRR precisely because I know how much money I'm going to make and I know when I'm going to receive the money. And I tried to put too much science into the portfolio management of growth. And we had something like 20 holdings. And I literally have a model, like a financial model, like a DCF type model for every company. And I put all the outputs of those models into a spreadsheet. And I said, okay, here's our expected IRRs for all of our holdings. We should use this to help us optimize. And what actually happened was we ended up selling some things that we probably should not have sold. We ended up holding some things that we probably shouldn't have held, because at the end of the day, when you have any kind of projection model, you're going to be wrong. And, projection models are it's obvious, right? It's obvious in hindsight. But I ended up, trying to over optimize a bit, and it actually hurt my returns because I made some mistakes, and some of the mistakes and really what you would expect would happen, right? Which is that we started to go overweight stocks where we had higher implied returns, and we started to sell some of our higher quality businesses because they had slightly less implied returns. And what happened was we had a really big drawdown, which resulted in 2022 giving back most of our alpha. And then at the end of 2022, I was like, okay, there's something wrong with the way that I'm managing this. And I did a really intense study of basically every decision we had ever made in growth portfolio, and really trying to own the mistakes. I've written about them in my letters, which are public. especially my Q4 letters are the letters where I try to like draw on the learnings and like really reflect on what did we do wrong, what did we do right. And starting in 2023, I rebuilt the portfolio management, I guess is how I would put it. And the basic realization that I had was that, a lot of our underperformance, it wasn't bad stock picking, it was bad portfolio management. And it wasn't something that I appreciated enough until I had really studied it. And so I've created all sorts of so I try to walk a fine line, right? Because obviously a rule driven system of investing works for me and event driven, and I really like having rules. But I also realize that when you're buying, assets that have terminal values, that you need to have a little bit more flexibility in terms of how do you define value, where do you see the value emerging, and how do you capture that value, right?
Indeed.
And, yeah, and so I built it up, and so like if anybody who goes and looks at my letters, I have rules, but they're like, it's kind of like these are rules, but there's like still a lot of flexibility around the rules as to how you kind of interpret how you interpret things.
There's so much wisdom in that, Luis. I had an old boss for whom I was building a software system, and she would tell me this: there are all kinds of rules, and then you have to build me exceptions to those rules, because there are times when the rules don't work.
Right.
I've built quant systems as well in the past, and one of the mistakes we made was overfitting of data,
Right.
as you know quite well, or as more folks would normally say, is torturing the data until you get the results that you want. And you're right, in growth investing, that doesn't necessarily work because you need a lot of intuition there and know when to break those rules.
Exactly. So it's like I have as few rules as possible, but I have enough rules so that I don't completely go off the rails.
Exactly.
Makes sense. Speaking of these rules, actually, I know we kind of covered this for the merger arb strategy. You talked about looking for merger arb or like event-driven activity in terms of looking for the highest yields. How do you go about picking ideas for the growth portfolio? Is it mainly based on intuition? Are you looking at screens, sell-side research? What's the investment process on that side?
I look at everything is the answer. But the big flip that I had was, it's funny because it's like I knew these things when I started the growth portfolio, and then it's like I had to make the mistake to relearn the lesson, which is that when I started the growth portfolio, it was buy quality businesses, focus on businesses with expanding moats, really deep and long reinvestment runways run by, ethical operators who had skin in the game, right? And that's really it. That's really what we're looking for. We're just looking for great businesses run by great people. But then when I shifted and focused more on IRRs, what I ended up doing was I was putting valuation first, right? So
that never works.
And I think value investing works, but I think when you try to mix value and quality together, that's where you have issues.
That's exactly right.
If you go straight value and you ignore quality, that works. If you go quality and back it into value later, that works. But if you're trying to simultaneously mix quality and value, that's extremely, extremely difficult.
Yep.
in my experience.
Same here. I've been hit quite hard by that. Yep.
So what I did in 2023 is I realized the mistake, and I said, okay, valuation goes to being the last step in the process again. Let's go back to basics, right? I learned the lesson. So let's put quality first. Let's find great businesses with the strongest ability to, over the long term, compound their cash flows. And then, basically I made all these filters for quality businesses run by quality operators with good unit economics. And then at the end, instead of focusing on, is this a good IRR? Instead, what I'm focused on is the valuation prohibitive to me, right? So it's not about is the valuation good, it's is the valuation bad. I've inverted it, right? So basically, if I find a really, really good company and I don't think it's overvalued, if it's just fairly valued, I'm willing to buy it if I like the business enough and I feel like it's going to compound. So I kind of inverted that, and that's at the heart of in terms of what changed in that part of the process.
Got it. This is a perfect segue into discussing Netflix, which is a company you and I exchange emails about. So it looks like both of us got into Netflix independently of each other sometime in 2022. This was the time when the stock had taken a pretty big hit after subscriber growth had stalled for the company. Bill Ackman got in and then immediately got back out. I got in over 3 different trades. My first one wasn't the best. It went down quite a bit from there. And then I picked it up again. And then a third time. I don't average down on companies, but I usually will lay it out saying I will buy 3 times in 3 tranches. And then I will execute on it. But not just because the company went down. We wrote about Netflix actually in 2010 when Jay Hoag, who had been on the board of directors of Netflix since 1999, he's a partner and founder of TCV, bought stock in Netflix after the Quickster fiasco they had. So they rolled back that. It created a wonderful buying opportunity and he bought in. So when this thing happened in 2022, I was reminded of what we wrote about 10 years before that. And I was like, this is an opportunity for me to buy Netflix. I think the difference between what you and I have done is I have scaled back some of my Netflix exposure over the last year or so. And the reason I did this was, I went, like you said, I picked it up based on the quality of the business, but I did do the valuation, did build the DCF model multiple times as time progressed. And I have a friend whose wife works at Netflix, and they have a wonderful perk for employees where you can put 100% of your salary into Netflix options. You get them for 40% premium, and you get them at an expiry date that is 10 years into the future. And so every few years he reaches out to me and he says, hey, what do you think of Netflix? And I run a DCF model and I walk him through it, just as a thought exercise, if nothing else. So I'm curious to see where you think things are going with Netflix. Clearly, the stock has appreciated a lot since we bought. The valuation is higher than where it was back then. And to me, it seems like subscriber growth is slowing down. They've stopped reporting subscriber numbers recently. So that is another little bit of a red flag. And to top it all, Jay Hoag was selling as well. So I just wanted to get your opinion on why you continue to feel bullish about Netflix and are holding on to the stock.
Yeah, and full disclosure, I'm still a shareholder, and my clients are still shareholders. I'll tell you how I got involved. In 2022 we fortuitously started buying shares, and this was because we were shareholders of another company called Avid, which has subsequently been acquired. But Avid was basically a company in the Netflix ecosystem. They were selling the software tools that were used to edit films, and so that was we had done a lot of research of that ecosystem. I had spoken to a lot of film production companies just trying to understand what tools they were using. And then Netflix would come up from time to time, and effectively, Netflix was a very controversial stock. It was in free fall for various reasons. They benefited a lot during COVID, and then they had some subscriber churn. They had an air pocket in the content they were releasing, and there were a million reasons to be bearish on Netflix. But one of the reasons that people were bearish, and one of the reasons I had stayed away from it for a long time, is I always just viewed it as a company that had very little spending discipline because of they had these really inflated content budgets, and they weren't generating they weren't making a lot of money. They had all this high yield debt, and if you were a discerning credit analyst, you might even say it was potentially a credit risk at some points in time. And I happened to be in the right place at the right time. I was talking to a lot of people in the film industry, and I started asking them, well, what do you think about Netflix? What do you think about the streaming ecosystem? Because part of what I wanted to understand was, if for people who are using the software to make films is like, well, what the outlook was for the for the film production industry, like how many more films were going to come, and so how much more growth in seats and software licenses could we expect? And I heard some really interesting feedback from people who were basically stakeholders of Netflix. And the feedback that I was hearing was that, like, basically everybody wanted to work with Netflix over working with the other companies. That was the original thing that I heard. And, there was a number of reasons why, but like this was in 2022. So I think at the time, I can't remember exactly when this was in the timeline, but Disney Plus was also having issues. Warner Discovery, I think, was like either had just merged or was in the process of merging. And basically, the industry was a disaster. But then if you ask the people who were selling projects and who were working with these companies, everybody spoke really, really highly of Netflix and really, really poorly of everyone else. Like I remember I was talking to one film production company and they were just really, really upset with HBO because HBO violated their contract and just canceled all their production because they needed to cut costs. And then when they talked about Netflix, they said, well, you know what? Actually, Netflix, they also have a spending issue, but instead of just canceling our projects, they just let us like deliver it to them more slowly. But then they said, but also we've noticed that Netflix is becoming a lot more thoughtful in the way that they're ordering content, where now they're not just writing a blank check. They're actually, trying to get more feedback and like giving us more data. And it really got me thinking. And, at the time, the narrative was that Netflix was just a total disaster. They were spending too much money. They could never be profitable. But now it's starting to hear things from the ecosystem that actually Netflix was doing a lot of really interesting things. They were evolving to becoming maybe more mature in how they spent money. And so then I started to talk to former employees of Netflix. And I started to learn more about the culture. I started reading more about like the founding and operating principles of the company. And I started to realize like, okay, this is actually like a really special culture and run by really special people. And after getting all that feedback from the ecosystem, I bought a small position because like, you know what? If they just like make this profitable, the stock's cheap. Because I think at the time when I made my first buy, even on GAAP numbers, the stock was like 18 times. Right. And they had just started cutting. And then they started to show some more progress on being like cost disciplined. And so I actually started adding to my position. And then at a certain point, maybe the stock had we actually we started buying when the stock was below 200. Right. So we had really good timing, very lucky. And we averaged up a bit, we averaged up all the way, I think, into maybe the 400s is when we stopped. But after we doubled I think at the time what happened was, and I'll get to how this relates to today in a minute. But at the time, people kind of all agreed. They said, oh, okay, yeah, Netflix can be profitable. They've shown that they could be disciplined on costs, and they did a lot of radical things to rationalize the cost base. But then where my new variant perception was, I actually think not only can they continue to execute on being profitable, but I actually think they're under monetized, right? Because that was when they just started to roll out the advertising or like the idea, the concept of like the ad model. And they also were starting to make investments in the video game side. And, if you look at the problems that Netflix has, the biggest problem is churn. And the biggest problem is that people don't want to pay X amount of dollars per month. And the ad tier is such a great product innovation for them because it significantly reduces, the entry-level price, which simultaneously reduces churn. But also, we believe at the end of the day that the ad tiers can be more profitable for Netflix than the paid tier. But also, it gives them more pricing power on the paid tier. So it's a really nice flywheel for the whole business, right? So then our differentiated view became like, actually, we see a pretty nice reinvestment runway here because, they're going, as they roll out the ad tier, it's going to help them pick up parts of the market where people are more price sensitive, and it's also going to help them better monetize. The other thing that I was hearing, just because we are like part of our process on the growth side, is we do a lot of scuttlebutt. We try to get as much information that is not in the financial statement as possible to better inform our views on like the culture of a company, the quality of the products. And that's where I think that we can really develop like a long-term view on like where the company's heading based on, what the strength of culture, which in my opinion, company culture is the strongest competitive advantage, of any company is a view that I've developed. But what I was hearing about Netflix at the time was how quickly and effectively they built out that team internally to roll out the ad tier. And it happened within like a quarter. It was amazing what I was hearing. It was amazing like how quickly they were able to stand that up. And that's when I knew, that's when I became like super bullish that, okay, you have like basically, the Usain Bolt over here, which is Netflix, which quickly pivots their entire business model, quickly pivots, goes from a company that just has an unlimited pocketbook to buy content to, being very rational and thoughtful and more discerning on how they buy and program content. And they're also able to just technologically just do things. And then at the same time, I was doing a lot of scuttlebutt on every other company they were competing with. And these guys were just like falling on their face left and right. They couldn't integrate old tech assets. They were paying McKinsey tens of millions of dollars to help them find new ad tech, and just disaster after disaster. And I mean, now, we're in June of 2025 and Warner Discovery is going to split again.
Yes,
these guys are still a disaster, right? It's, part of why I think Netflix has worked so well is because of how weak their competitors have been. And part of it is just how strong they have been. And the combination of two is really what I think has created their ability to just dominate the industry, which is what they've done. Now, looking forward, I think we're actually still really, really early in like monetization of the ad tier. I think I think there's so many interesting potential runways for them to go down. Everything from user-generated content, which is really not in the cards today, to, they're working on video games. Video games is an area that there's huge potential to both improve monetization, improve, the number of subscribers that would be interested. I'm incredibly bullish on what they can do there. But at the end of the day, and this actually kind of links back to the point we made earlier where it's like, yeah, sure, if you look at Netflix's PE ratio today and like what analysts are expecting, it doesn't look cheap anymore. It's definitely not 18 times forward anymore, right?
Mm-hmm.
But if you come to it with the understanding that, oh, actually, this company culturally is incredible, and once they figure out, product market fit in like video games, or once they figure out, maybe how to do live, which is a huge opportunity, or how to better do sports, or can they do something in like live streaming or user-generated content, or what are they going to do? Like, how is AI going to help or hurt them, which is a really interesting topic. Like, my conviction comes from just understanding the culture and the way they make decisions and how quickly they can capitalize on that. And not only understanding that, but also how relative that is to the competitors who are going to seemingly always be several steps behind.
Absolutely.
Yeah.
One of the advantages of living in Silicon Valley is you somehow end up with some of that scuttlebutt. So talking to Netflix employees, I hear about how difficult it is to get into the company as an employee, and that if you don't perform, you don't stay there very long. So that's part of that culture that helps them execute so fast on some of these priorities. And then the cherry on the top for me back in 2022 was this interview that John Malone was doing. And the company spoke about most admirably was Netflix. And I was like, if John Malone is speaking about Netflix this way, clearly there is more value here than Warner Brothers Discovery, if you will.
Absolutely. Yeah, I remember that interview.
Yeah, and what you bring up about the whole like streaming service and production and film production industry right now. Warner Brothers Discovery is splitting up. That's a bit of a mess right now. We just saw the separation of Lionsgate Studios from Starz Networks, and surprisingly enough, the Starz parent company's what's doing better following the spinoff. We actually expected the studio business to do a lot better. So it's been an interesting ecosystem for the time being. So basically what you're saying is Netflix is still superior, Netflix is still king amongst all these other companies, right?
Absolutely. I think brand value, strong. But again, it's like, a lot of it comes down to culture for me. And, I do talk about stocks in my investor letters from time to time. And it is a theme. Like I'll spend like a disproportionate amount of time talking about like how we think about the company's culture and how we judge that, right? And it's something that I think is universally you can make that judgment universally across any company. It doesn't matter what industry that it is. There's usually, not always, but there usually is certain signals that you could pick up on that kind of can give you an idea that, oh yeah, all the best talent in this industry wants to work here, and all the stakeholders, if they had a choice, they would work with this company, and that gives them incredible market power. And if we can't figure something like that out, then that's probably not something that we can invest in. But if we can figure it out, that actually definitely it perks our interest.
Makes sense. So it's been great to hear about an investment that worked super well for you, like Netflix. But obviously, investments don't always work out perfectly. Could you tell us about an investment that maybe didn't play out exactly how you expected and any learnings from it? I've been reading your letters for quite some time. I know Medpace was a stock that you've talked a lot about in the past, and you made the decision to exit. What led you to Medpace, maybe, if that's something you want to talk about? And then more specifically, what led you to exit, and how have you learned from these investments that didn't quite play out as you expected?
Yeah, absolutely. So, and the decision to exit is largely a risk management decision, actually. And so it's not to say that I'm out of Medpace forever, but it's to say that I've made a risk management decision to take a small loss and to re-underwrite the position. So it's not that I actually still have a lot of respect and optimism for Medpace, but this is something that I had to learn because what happened, one of the things I learned when I studied the mistakes that my past mistakes is that I kept averaging down on certain positions that I felt really strongly about. And, so one of the rules that I had to instate is, well, there's many rules, but one of the rules is if I've held a position long enough and it hasn't worked, like it's significantly underperformed both my expectations, but also performance-wise and fundamentally, then I sell it and I re-underwrite it. And I've done that, and and I also wrote about Booz Allen last year, and that was another stock that I sold, but I actually bought it back because I re-underwrote it, and I bought it back actually earlier this year, and so I may be back in Medpace, and I guess, so maybe I'll talk about like why I got into Medpace and why I think it hasn't worked so far. But basically, Medpace is a contract research organization, and they partner with biotech companies and pharmaceutical companies to run clinical trials. So a good way to think about it is it's like a very highly specialized business process outsourcing company or like consulting company where like if you're a biotech company and your core competency is discovering new drugs and your core competency is not navigating like an FDA regulatory approval process because maybe you've only done 1 or 2 drugs in your company's history, you can partner with a company like Medpace who literally has 500 ongoing clinical trials, and they will, make sure that your project is submitted on time and under, is in good hands with the FDA. So it's a huge value prop. And as a business, there's a lot of things I like about the business model and a lot of like longer term tailwinds. I mean, among those longer term tailwinds is the pharmaceutical and biotech industry. There's been a lot of innovation, so there's a lot of drug candidates, enabled by, AI is a huge enabler right now, but there's all sorts of, innovations that we've seen over the last 10 years, whether it's genome sequencing or like nuclear medicine. There's been a lot of interesting work done in oncology and like targeting certain cells, for example. And so there's a lot of drug candidates. And I think there's going to continue to be a lot of drug candidates. But what the larger pharmaceutical companies have had is it's kind of like the oil and gas industry, where there's been heavy cost focus to the point where anything that is not like actively generating revenue is something that they want to like cut or like outsource. So the CRO industry has been gaining share, and over time, I think maybe 20 years ago, only like 20% of clinical trials were outsourced, but today it's over half. Okay.
Yep.
What I like about Medpace is they do what's called full service outsourcing, and which means that they don't just take one piece of a project, they want to outsource the entire thing because they just feel like they can get better outcomes, but they can also drive lower costs. But the reason why that's interesting is because from a shareholder perspective, if you're like a bigger partner and providing more value, then you have, if you're driving more value, you can capture more value, right? So they have better margins. It's also an industry where your reputation is extremely important. And so it's not a business where if like you or I try to start a CRO tomorrow, we could go and convince Pfizer to give us a contract to do a clinical trial for their drug. So there's real specialization, there's real differentiation, and there's a lot of tailwinds. And like, as I've written about in my letters, Medpace has a really, really special culture. It's still run by the founder. Because they vertically integrated everything, because they found that not only can they have better outcomes, but they could also have much lower cost. So their cost advantage is so extreme that they can earn like they bid out projects and earn double the margins of their competitors at prices below where their competitors can even operate at cost.
Wow.
It's a really, once you kind of learn about how they operate, and they're the only company at scale who runs with this business model, then you realize, okay, they're doing something really special, and it's not clear that anyone else can even do it. So, and because of all that, over time, they've CAGR'd revenue at like a 20% organically. They have like a 60% ROIC. Like, the numbers are insane. Their stock has been like an 11x since their 2016 IPO. And it's not statistically expensive. It's something like a market multiple right now.
Absolutely.
Now, what went wrong, right?
Yeah.
So that all sounds great. That all sounds great, does. Right? And that's how I underwrote it. And I started investing in it at the end of 2023. We added to our position in 24, and we decided to take our loss in Q1 of 25. And what happened was basically just extreme cyclicality in the biotech world, where perhaps some of the earnings that we underwrote earlier on were kind of excess earnings from overinvestment stemming from the pandemic, where there was a lot of money that was being thrown at the biotech space, which definitely created a bubble in biotech. And what's happened in the industry is the industry has gone from like extreme capital surplus to extreme capital starvation. to the likes of which nobody in the industry has ever seen before. And it's not clear when that period of starvation will end, right? So what we're seeing is basically good drugs not getting funded. And we're seeing companies that otherwise have really good assets just not finding the investor base for it. And what that means for a company like Medpace is their customers are dying, right? They're seeing a lot of churn in their customer base, not because their customers don't like Medpace or don't have good assets. It's because they just can't get funding. And I think logically, if you, it's tough to know. I mean, I think logically we're probably closer to the bottom in the biotech cycle than we are to the top. So logically, maybe you should just, buy some Medpace stock or buy a CRO stock. I mean, not investment advice, obviously, but hypothetically, you can buy a biotech related stock and hold it for 10 years and you probably do really well. And yeah. And I'm just trying to figure out, I mean, maybe to end on, right, what I'm trying to figure out is, so when we underwrote the stock, we made certain assumptions and certain projections. Our numbers were all too optimistic. The company itself has made certain projections and estimates, and their numbers they went from an environment where they were always giving what seemed like aggressive guidance, but always ended up where the numbers were significantly beating their expectations, to now the last few quarters they've given what seems like extremely pessimistic guidance and the numbers missing by a big margin. So what that means is, like, there's just not a lot of visibility in this business, right? So the insiders themselves don't know where their business is going to be in a year or 2 years. And so I'm just trying to grapple with that. Like, how do I value this business that is a lot more cyclical, or maybe this is just a really special time or a really special cycle? How do we value that business when we underwrote it to be maybe something that was a little bit more non-cyclical and had a different set of assumptions to the current reality? And once we figure that out, we may end up getting back in the stock once we build that confidence again, but we just need to build that confidence again.
Absolutely. As I talk to friends who are biotech investors or work for biotech companies, either in research or on other fronts, it very much feels like a nuclear winter in biotech land at this point in time. And even with CROs, I think I first came across Medpace in mid 2022 when the founder CEO was buying stock. It was $140, $150. It's still up quite a bit from his purchase. And it was an opportunistic purchase. This wasn't a true believer insider, if you will, that was constantly buying all the way down. He made an opportunistic purchase. It worked out well. And so one side of CROs is that we have this nuclear winter in biotech. But the other side that I've been discussing with some biotech company insiders is the impact of AI. Does this actually help CROs because you're going to have additional candidates that get to phase 1, 2, 3 trials sooner, or is it going to hurt them? So, Luis, I was just curious to see, how do you see the impact of AI on CROs?
That's such a great and hard to answer question. And
Yep.
I went to the industry conference for CROs in February. It's the Scope conference, and I went there in person. And they had a big convention hall, probably had 500 booths, and I went booth by booth asking really similar questions. And one of the things I learned at the conference, I got to meet all these AI startups. And they got to tell me all the ways that they're using AI to disrupt the industry. And I would say that I'm less confident in my assumptions on how AI is going to improve the industry, but there's a few. I think there's a big picture way I think about it, really, which is that at the end of the day, the big pharmaceutical companies, but also like people who invest in biotech companies, they want to get an ROI, right? So if AI helps improve the ROI of their clinical trials, that means they're going to invest more money in clinical trials, okay? Which is theoretically good for the industry. The other side of that, though, is if you look at what Medpace's business actually is, and it's like a business process outsourcing business, could AI actually take away some of their profit pool? It's possible, right? Because what is that business actually? That business is actually designing a clinical trial. Okay, well, AI can help you with that. It's recruiting patients for a site, to people who have an illness to go to a site and to be administered a drug. So AI can actually do a really good job of like going through databases of EMR systems and like identifying potential candidates. So that actually is something that could potentially reduce the profit pool on that part of the service. But of course, like at the end of the day, like and then you have patient monitoring, analytics, and then writing the reports and submitting to FDA. So there are things that AI can't do. So AI can't do a quality control like audit of a site, because that requires a person physically going somewhere and making sure that the site is doing what it's supposed to do. AI can assist with like writing reports, but at the end of the day, like I don't think anybody is going to trust their billion-dollar asset like solely with AI. They're going to have humans work with the AI. So I think at the end of the day, I don't think AI is a reason to not invest in a company like Medpace. But it does make it a little bit harder to try to figure out like, okay, where's the business going? If I had to guess, it's like the same lens that I would apply with like Netflix, for example, when, my assessment is that Medpace has, the best mousetrap in their industry. And they have the most effective leadership. They have a phenomenal company culture. I think they're going to figure it out. And I think they're going to probably be in a position to figure it out better than, some of their larger competitors. But there are things that are worth considering. I mean, the biggest one is just the idea of, well, does AI mean a pharmaceutical company is less likely to outsource to a CRO? I think at the end of the day, because maybe AI helps them do certain things cheaper in-house that they historically found cheaper to do outsourced. So it's not 100% clear to me. And there's a lot of things about AI and drug development that probably will take a good minimum 5 years, but more likely 10 years to figure out. Because, for example, AI is really helpful in discovering drug candidates, and it's also informing people of like which like trial designs are more likely or less likely to be successful. But we won't actually know the output results of what AI did until it goes through a full clinical trial, which takes 5 to 10 years. So a lot of it is, a lot of it is to be determined. I mean, at the end of the day, like if I go back and I think about, where I draw my conviction from is like, I really like the organization and the way that it's set up and their business model. I think they'll figure out how to best adapt to the way the industry is changing. What I'm having more difficulty with is trying to figure out how much worse does the biotech cycle get? How long could it last? What are the long-term ramifications of it? There's a few other things too. There's been a lot of, let's say, regulatory changes or suggestions that could change the entire industry, that create a lot of uncertainty. Not just uncertainty for me as an investor investing in Medpace, but uncertainty for people who are making investments into drugs that Medpace could then work on, right? Like things on whether or not we're going to put tariffs on drugs, or whether or not we're going to remove certain requirements of clinical trials, or maybe on certain classes of trials like vaccines, we're going to be adding new requirements. And there's a lot that's hard to figure out right now. And at the end of the day, there's certainly value in Medpace's stock, and I do like the setup, but it could also get cheaper.
Yeah.
Makes perfect sense. Yeah, I think also from reading your letters, you were invested in Icon, another CRO, at some point, right? And you've also exited that position, I'm assuming for very similar reasons of the whole CRO
very different
industry. Oh,
very
really?
different.
Interesting. Could you go ahead and talk about that?
Oh, that's I'm so glad you mentioned this. So I discovered, so at first, when I invested in the CRO industry in 2023, I was attracted to it because I just thought, oh wow, this is like a really cool industry. This is like, you know, they're doing valuable services for biotech companies, and you know, as somebody who is very bullish long term on the trajectory of biotech because of all the innovation and things that are happening, but I don't have like a biotech PhD. Like I view this as, oh, this is like a really interesting way to get exposure to that industry without having to make a bet on science, right? So first I bought shares of Icon and Medpace, and I view them as different bets because Icon has been more of a consolidator. They've been acquiring other CROs and to build the scale of their business. And Medpace has just been that organic grower, more focused on that full service trial that I just mentioned. And after I bought, like buying a stock, just for me is just like the beginning of the research, right? You and especially because of my process, because I tend to start with small positions, and I tend to increase my position over time as I like build my research stack and gain confidence in what they're doing. And like they actually show me, like with execution, that yeah, the things that I underwrote not only are true, but they're like showing me that in real time. And there's nothing like owning a stock and like living through the experience of, you know, the company executing or not executing. That for me, it's just viscerally different than going back and reading past annual reports and 10Ks when I didn't own the stock. It's very different. And that's one of the things I realized when I studied my own history. But with Icon, you know, I bought both the stocks, and then I started to do more like scuttlebutt. And I spoke to people who were familiar with Icon. I spoke to people who were familiar with Medpace. And, you know, kind of similar to what I was saying about Netflix earlier, the feedback I was getting from Medpace was like very positive, and the feedback that I was getting from Icon was much more mixed. And
oh, interesting. Okay.
Yeah, and what I eventually realized is that I just didn't like their strategy, and it actually built my conviction in Medpace because it made me realize, oh wait a second, what I realized was Icon's strategy was they were using leverage to buy competitors and trying to get synergies. But what was actually happening is when Icon buys a big company, if they have a mutual customer, let's just say Pfizer, Pfizer wants to be diversified amongst its suppliers. So what I actually realized is that there were dyssynergies, right? Because if Icon had $100 million of business from Pfizer, and they bought a company that had $50 million of business, Pfizer's like, actually, we don't want to have more than $100 million of business with anybody. We're going to cancel. We're not going to pick this vendor going forward. And then on top of that, there were all sorts of issues with integrating these acquisitions where, from the customer's perspective, what customers were telling me is, oh yeah, like the people we were working with at Icon kept changing because they kept restructuring all the organizations, and it was like a really terrible experience. And my view ended up becoming that, oh wait, Icon is just doing something that's very financialized, and you know, they're able to show results because the whole industry was in a tailwind, and you know, they're using a lot of leverage. But what I realized was actually what Medpace was doing, organically delivering similar or if not superior results, but doing so by building like the culture internally and training everybody, having much less turnover of their associates, and just being more consistent with their value proposition was actually a much better strategy. So I actually sold my Icon and used the proceeds of the sale to double my position in Medpace, and that's the trade that I did in 24. And you know, for better or for worse, I think Icon stock fell something like 70 or 80% since I sold it.
Wow.
And
Wow.
I think the loss I ended up taking on Medpace was like maybe 5%.
That's amazing.
So
A roll up with leverage and not enough synergies. I wonder where we've heard that before.
Right. But the thing is, Asif, you see, this is why I think the qualitative research is so important, because point in time, if you just looked at when I bought Medpace and Icon, their historical financials for the preceding like 15 years looked really similar. They were both showing similar levels of compounded revenue and earnings growth. And in my view, I view them as different bets, because I was like, okay, like one company is doing this thing organically and one other company is doing this thing inorganically. They both, on the surface, they both seem to be working. But then when you actually start to try to build the brick by brick, like, how does this work? What's the quality of the product? What are customers saying? What's the feedback from the people who used to work there? Then you start to see, oh wait, yeah, like the financials don't tell the full story. And that's where, like, having that qualitative insight and bringing a lot of things that are outside, I obviously use the financials to help me figure out, like, okay, like, is free cash flow per share actually accruing to shareholders? Obviously, like, that's a foundational thing, but then it's not just, is free cash flow per share accruing to shareholders? It's, how did they get that free cash flow per share to accrue to shareholders?
Right.
And the answer to that is something that needs to be studied outside of the financial statements.
Absolutely. We just came across an insider purchase by John Paulson of Bosch Healthcare. And this is the old Valiant Pharmaceuticals. And just yesterday we were talking about, this was a financial roll-up with a lot of leverage and it blew up. So when you were talking about the same thing with Icon, and I'm not comparing both companies, Tamanna wrote about Bosch as the Enron of healthcare, if you will. So there's nothing similar going on here, hopefully not. But just that, the roll-ups with a lot of leverage, and more often than not, blow up.
And this is one of those things where it's important to not have too many rules, because
yep.
I actually I own some companies that are serial acquirers, but they might, they might just be better at it than Icon was.
Right? They could be, yeah.
Not, you could look at, Constellation Software as a really good example of, you can be a serial acquirer, have a really differentiated process and good culture around it, and consistently drive superior results, right? So a lot of it for me comes back down to, like, how's the business being run? What is, like, the true essence of its competitive advantage? And, for me, like, I just keep finding, like, culture is increasingly important to driving the sustainability of that advantage.
And that might be the one advantage we would have over algorithms, because it's harder for them to figure out the culture side of it before humans could potentially do it. So just one last comment, and then we can get into a set of rapid fire questions. Just going back to CROs, and we were talking about the impact of AI. I've been involved in a healthcare company in the past that partnered with a CRO, and this was on the patient recruitment side of things. So I feel like, things like AI helping you figure out the right patients could be something that could also accrue value to the CRO side of things, because they could benefit from using AI on their operational side of things, and maybe margins can improve over time for them.
Right. I think, the one thing that you'd want to think about with that too is, who actually has all the data, right? Medpace has done thousands of clinical trials. And so do they have more data? Like, you could actually argue that they have more data than a Pfizer or an AstraZeneca, just because they see so much. And that's not to say that that's the reason why they're going to win in AI, but there's a lot of interesting, in the context of AI, I think the framing of your analysis changes, and that's actually definitely something that's changed since I first got involved. Is the AI has actually reframed the thesis, and again, this is why, like, sometimes if I'm proven not correct in my initial assessment, sometimes it's just helpful for me to, like, sell, and if I could take a small loss, it's it's not a big deal. I can reassess, do a new project, try to start from a blank page. And for me, like, this is not to say anybody else should be doing it this way. I just figured this is something that works for me. For me, it helps me, like, not lean on too many of my historical biases when I'm
That's exactly right.
When you start thinking about, like, endowment bias or confirmation bias, like, for me now, it's like, it's neutral. Okay, how exactly do I think AI is going to impact this thing? Well, I don't own it, so I'm a little bit more open to the possibilities.
I love that approach, Luis. I think I'm going to steal that approach from you, because the bias thing, it's so hard to get over once you have a position. And so getting out of the position and 100%. Reassessing it is so important.
Great. We can get into the rapid fire round. I wanted to ask, has there been any books you've read recently and gained any actionable advice from? How about any podcasts that you like to listen to? Are you much of a podcast person in general?
Yeah, I listen to a ton of podcasts. Again, like, I don't have anything in mind. I what I would say actually is that because I spend so much time, all I do is look at financial data all day. Sometimes it's nice to listen to a podcast or read a book that's not about finance. And I find that actually that can help me kind of escape a bit. So I still listen to a ton of finance podcasts, and like I've been listening to your podcast. I listen to all the other great podcasts out there that are in finance, but I definitely try to broaden my horizons too sometimes.
That makes perfect sense. That was actually going to be one of our other questions. Is there anything that you like to do in your free time that's like non-finance related? Any recommendations, anything fun, so on and so forth?
Yeah, this probably explains why I haven't why I haven't had so many books on my mind lately, is because what I like to do a lot of the times is actually play video games after work.
Good for you. Me
And
too.
I'm really big into strategy games, so I'm really big into like real-time strategy games. So my favorite game is Age of Empires. I'll play that a couple of hours here and there at nights and on the weekends.
Did you ever play StarCraft back in the day, Louis?
Still do.
Oh, wow.
There you go.
I played that for years.
Yeah, internally with our team, usually like once a month, we'll have like a couple of hours one afternoon where we'll just like all play a game. And we've played StarCraft as a group. We've played Age of Empires, and we'll play other things too.
That's wonderful. I used to do that
it's
with
interesting.
Yeah.
Well, it's interesting because we're a remote company. Like my analyst is in New York City, and my business partner is in Connecticut. So actually playing video games is one of the ways that we could have some kind of like interaction. I mean, we obviously we see each other in person periodically as well, but it's been an interesting modern thing that we do, I guess.
That's wonderful.
Yeah.
So, Louis, we could continue talking to you for the next several hours, but this has been a wonderful conversation. We both thoroughly enjoyed it. And we look forward to having you back on in the future, especially if there's a company or industry that you find fascinating. We would love to have you back on the podcast.
Yeah, absolutely. Thank you guys so much. This was fun.
Thank you so much for being here.